Fred Neumann. Fred is co-head of Asian Economics Research at HSBC. So there's a bit of difference in the official data and your data. One is showing expansion, the other contraction, but it's not that big a difference, is it?
It's not a big difference this month. There are always some discrepancies between the two series, but I think overall it's showing a slight expansion in the economy, not as much as we would like actually at this point. If you look at new business orders, for example, coming in, they have declined slightly in February. Now, there are always Chinese New Year distortions, but it's clear that the big push...
Yeah, what has been the impact of having this early Lunar New Year?
Well, it's always hard to seasonally adjust these data. The survey data is always very seasonal, so it makes it, if the Chinese New Year shifts around, it makes it very hard to strip that out and clean it out of the data.
Okay, well, you know, what is the translation from basically what is flattish growth, I'll put it that way, in terms of manufacturing? What is the read-through when it comes to the overall economy?
The read-through is about 8% growth, thereabouts. So even if the HSBC PMI comes in below 50, it's still consistent with about 8% growth.
How does that work?
Well, it's an empirical relationship. So we know that over time, if the index is around 48, it's perhaps consistent with about 8% GDP growth. So you really need to see a bigger decline. It's the same with the ISM in the US, for example. A US contraction only really occurs when the ISM is below 44. But here in this case, we'd like to see more new orders, and they haven't really come through yet. So we do think that the Chinese government will have to cut RRs more just to stimulate the economy further.
Inherent dangers doing that, though, given where the oil price is right now. You've got to be vigilant when it comes to, vigilant when it comes to the inflation picture, and oil prices where they are right now are going to hurt.
That's right. The PBOC is really between a rock and a hard place here. You have, on the one hand, you still have fairly elevated inflation pressures. We saw even in January CPI go up in China, oil prices are rising again, and yet it's clear that this PBOC still needs to cut the RRR. So it's a very tricky balancing path, and they have waited so far. They haven't been very aggressive, and we would expect that cautionary stance to continue.
Not the only reason why we could have inflation. We've got liquidity pouring into this part of the world, given what's been happening in terms of effective quantitative easing out of the European Central Bank, and indeed other places as well where they're investing here. I know that China sterilizes quite a lot of that, but still it does affect things.
Yes, China would probably, again, continue to buy, or again start stepping into the market and buying FX reserves, which then adds to liquidity locally and would come on top of RRR cuts. But elsewhere in the region as well, we see enormous amounts of liquidity pouring back into markets. It's not just the LTRO of the ECB, it's actually also BOJ. The BOJ has turned on the taps. They're sounding very dovish.
That was a bit of a surprise, wasn't it?
It was a bit of a surprise. Putting out their inflation target, saying we expand the balance sheet by 30% till the end of the year. It had an impact on the FX market.
It's kind of like somebody came and woke them up one day.
Yeah, I think that what woke them up one day is Europe, right? Yeah. They suddenly see this enormous debt.
2 years after the crisis.
2 years after the crisis. But they see that even advanced countries cannot sustain a certain debt load, and Japan is in far worse shape over time than the Europeans are.
But you have to caution that most of that debt is held by Japanese.
It is.
So it's not a systemic risk as much.
Yeah, not at this point. But if the trade balance moves into deficit, and we already saw some signs the trade balance deteriorates, that would ultimately mean that Japan needs to import capital to fund its borrowing. And you can see that over 2, 3, 4-year horizon that Japan would have to raise its external borrowing, making it vulnerable to a withdrawal of capital.
Okay, but inflation is about to rear its ugly head, or is it not?
Now, we think that will be the story of 2012, that inflation will come back, that markets are a bit too complacent about the inflation risks out there. In Korea, for example, we now expect a hike at the end of the year because inflation hasn't really come off, plus oil is coming back. So that will push up price pressures.
Well, that's the main reason, isn't it? Or is it more to it than that?
It's oil. It is the liquidity. And it's also the fact that in Asia we've seen a structural deterioration in the inflation dynamics. Labor markets are tight. Populations are aging.
Wage pressure is what you're talking about.
Wage pressures are coming through. And all of that means that if you get a slight acceleration of growth, the bounce back in inflation will be even greater than in previous cycles because we have these underlying price pressures still bubbling away beneath the surface.
And the policy response, I mean, would you say it's better to act now rather than wait a couple of months?
Well, now we think that most of the easing that was priced in only a few weeks ago, that's probably misplaced. That was coming out. The central banks will probably not ease across the region. The Philippines today might be an exception, but broadly speaking, central banks are stepping back from easing. And we do think that towards the fourth quarter, they'll look at hikes again. Not imminently, because there's still risks out in the global economy, but we will be talking about hikes in due course.
Fred, pleasure having you on the programme as ever. Frederic Neumann there joining us. He's from HSBC.